everyone, welcome back to my channel. In this video, we will talk about how to read financial statements like an accountant, part 1. We will talk more details about the 3 primary financial statements and what they look like. We will also discuss the common used financial ratios for financial statements analysis. You will be more confident to read the financial statements. Okay, let's get started. The first primary financial statement is balance sheet. Balance sheet shows position, assets versus liabilities plus equity. It is a basic summary of value and ownership. It's usually prepared at the end of month, quarter, half year end, and year end. Here is the sample balance sheet. In the header, we have the business name, the name of the financial statements, and the point of time we are looking at. In this example, the name of the business is Maggie's Consulting, and this balance sheet is as at 30th of June 2025. On the left-hand side, we have the assets section. On the right-hand side, we have the liabilities and owner's equity section. On the left-hand side, it lists what the business owns, and on the right-hand side, it lists everything what the business owns. The assets always equal to liabilities plus equity. Assets are what the company owns or uses to make money. It has current assets and non-current assets. Current assets are the type of assets that are expected to be converted into cash, sold, or used up within 12 months or within the business normal operating cycle. For example, cash and cash equivalents, accounts receivable, inventory, prepayments, short-term investments, and other receivables. Non-current assets are the assets that cannot be fully converted into cash or used up within 12 months. They bring long-term economic benefits. For example, PPE, property, plant, and equipment, which include buildings, machinery, furniture and fittings, computers, office equipment. Intangible assets like software, goodwill, patents, and long-term investment. Liabilities is what the company owns to others. For example, suppliers, employees, tax office. It has current liabilities and non-current liabilities. Current liabilities are liabilities that must be paid within 12 months. For example, accounts payable, accrued expenses, income tax payable. Non-current liabilities are the liabilities that will be paid after 12 months. For example, long-term debt, deferred tax liabilities. Equity are what the company owns to the stakeholders of the company. In this example, we have capital contribution and retained earnings. Capital contribution is the original capital injection that the owners or shareholders put into a business. Retained earnings is all the profits the company has earned since it started, minus all dividends it has paid out. The second primary financial statement is income statements. Income statements shows a company's financial performance over a period of time. It usually prepared by monthly, quarterly, half-yearly, and annually. Here is a sample income statement. In the header, it shows the company name followed by the state name, income statements, then followed by for the year ended 30th of June 2025. The top part shows its revenue from selling its primary products or services, and the direct cost a company incurred to produce or purchase the products or services it sells during a specific period. The net is the gross profit. The second part is the operating expenses. Operating expenses are the day-to-day costs required to run a business, such as rent, salaries, utilities. Unlike the cost of goods sold, they are not directly related to producing a specific product or service. The difference between gross profit and the total operating expenses is operating profit. Then it deducts other fees like interest and tax expenses and gets the net profit. Please note, the net profit does not equal to the cash earned during the year. That is why we also need to prepare a cash flow statement, which we will be demonstrated shortly. Okay, the third primary financial statement is cash flow statement. Cash flow statement is a report, shows the movement of cash in and out during a period of time. It usually prepared monthly, quarterly, half-yearly, and annually. It has three sections: operating activities, investing activities, and financing activities. Let's look at the sample cash flow statement together. In the header, it shows the company names followed by the statement name, cash flow statement, then followed by for the year ended 30th of June 2025. In the main part, it has three sections: cash flow from operating activities, which reflect a business core activity. The second part is cash flow from investing activities and cash flow from financing activities. Then it has a net increase or decrease in cash. The bottom of cash flow statements has the opening cash balances at the beginning of the financial year, which ties back to the balance sheet as at 30th of June 2024, and closing cash balance at end of the reporting period, which ties back to the balance sheet as at 30th of June 2025. The next topic we will cover in this video is what are the 5 key financial metrics used when doing financial statements analysis. They are liquidity ratios, leverage ratios, efficiency ratios, profitability ratios, and market value ratios. Liquidity ratios. Liquidity ratios measures a company's ability to meet its short-term debt and obligations using its short-term assets. Most commonly used liquidity ratios are current ratios, quick ratios, and cash ratios. The second finance matrix is leverage ratio. Leverage ratios measure how a company relies on debt to finance its assets and operations. They show the company's financial risk, capital structure, and ability to repay long-term debt. It has debt to equity ratio, debt to assets ratio, debt to capital ratio, debt to EBITDA ratio, interest coverage ratio. The third financial matrix is efficiency ratio. Efficiency ratios measure how efficiently a company uses its assets and manages its operations to generate revenue. They tell the stakeholders how efficiently a company turns resources into sales. There are 4 key efficiency ratios: assets turnover ratio, inventory turnover ratio, accounts receivable turnover ratio, and days sales in inventory ratio. The fourth finance matrix is profitability ratios. Profitability ratios are financial metrics used to assess a business' ability to generate earnings over time relative to its revenue, operating costs, balance sheet, assets, or stakeholders' equity. They tell the stakeholders how efficiently a company turns sales into profit and whether its operations are financially healthy. Profitability ratios has 2 main ratios: margin ratios and return ratios. Margin ratios mainly have 3 ratios: gross profit margin, net profit margin, and operating margin. Return ratios mainly has 2 ratios: return on assets and return on equity. The last one is market value ratios. Market value ratios are financial metrics used to evaluate a company's stock price relative to its financial performance. They help the investors and shareholders to understand whether a company's stock price are fair valued, undervalued, and overvalued. There are 4 main financial ratios under market value ratios: book value per share, dividend yield, earnings per share, price to earnings. In our part 2 video, we will talk more details about the 10 commonly used financial ratios that we just discussed. If you like this video, please give it a thumb up, subscribe for more career tips, and let me know in the comments which topic you'd like me to cover next. Thanks so much for watching.